All right, welcome. Today we're digging into climate finance. We're going to go all the way from something as simple as the weather outside your window to the complex world of Wall Street. Now, this isn't just some niche topic anymore. It's quickly becoming a huge part of risk management and how we price assets. And for you, as you build your careers in finance, understanding this stuff, it's going to be absolutely critical.
Okay, so here's what we've got on tap. We'll start with the weird psychology that links weather to markets. Then we'll nail down exactly what we mean by climate finance. After that, we'll look at a really cool case study involving risk, belief, and real estate. Then we'll zoom out to see how the big institutional investors are thinking about all this. And we'll wrap it all up with a big question about what value even means.
So, first up, weather, mood, and markets. To really get a handle on climate finance, we have to start by admitting something. Markets aren't always perfectly rational. Shocker, I know. And there are some really interesting behavioral quirks that prove it. Let's kick things off with a classic example, just the weather. So let me ask you this. Can a sunny day actually move the stock market? I mean, it sounds kind of ridiculous, right? Think about it. None of the asset pricing models you've studied have a variable for sunshine. But this simple question, it cuts right to the core of behavioral finance. It's all about how human feelings, investor sentiment can mess with market results.
And believe it or not, the research says, yeah, it can. Good weather has actually been linked to higher stock returns. It's pretty wild. There's this classic study by Housel, Pfeiffer, and Shumway that found a real significant link between how much sun there was in the morning and whether stocks went up that day. What does that tell us? It tells us that our mood, something that has nothing to do with a company's fundamentals, can actually systematically affect how we invest our money.
Okay, so if daily weather can sway how the market feels, it kind of begs a bigger question, right? What happens when we stop thinking about short-term weather and start thinking about the long-term climate system? What's the financial impact of that? And that, my friends, is the central question of what we call climate finance. So here's the textbook definition. It's about financing investments, both public and private, to deal with climate change. But let's break that down. It really has two big jobs. The first one is called mitigation. That's all about funding the big shift to a low-carbon world. Think green energy, electric vehicles, that kind of stuff. The second job is adaptation. This is about paying for the stuff we need to do to protect ourselves from the climate impacts that are already baked in and we can't stop. And this gets us to a really fundamental tension, a tug of war that you're going to be dealing with your entire careers. On one side, you have value with an OE. The traditional bottom line, shareholder returns, dollars and cents. On the other side, you have values with an OUS, these broader societal concerns, which we often lump into this bucket called ESG, environmental, social, and governance. The billion-dollar question is, how do you plug these non-financial things into your financial models? It's a huge challenge.
All right, so let's make this less abstract. How does this big idea of climate risk actually hit the real world? Like, how does it affect the price of something you can actually touch, like a house? We're going to dive into a case study now that's a perfect mix of hard physical risk and squishy human psychology. So the question is pretty simple on its face. Does a risk like rising sea levels actually change U.S. real estate prices? I mean, common sense would say, of course, right? If a house is more likely to be underwater in 30 years, it should be worth less today. The physical risk is obvious. But, and this is a big but, the way the market actually reacts is a whole lot messier.
And the answer is summed up perfectly by the title of a really important research paper on this. The answer is, only if you believe in it. Just let that sink in. What they're saying is that the physical risk by itself isn't enough to move the price. You need something else.
And that something else is belief. This is what's so fascinating. The researchers found that the key factor isn't the risk itself, but what percentage of people in that area believe climate change is real. So get this. In coastal areas that are at high risk, but where people don't really believe in climate change, prices are totally normal, no effect. But in other at-risk areas where belief is high, those homes sell for about a 7% discount. It's incredible. It proves that asset prices aren't just about objective risk. They're about the market's shared story about that risk. Okay, so that's how individual beliefs can shape prices. But what about the big players? The institutional investors, the pension funds, the giant asset managers, the endowments that are moving trillions of dollars around? How are they looking at this whole new world of climate risk? Well, they tend to break it down into a pretty standard three-part framework. First, you've got regulatory risk.
This is the risk that governments will change the rules, right? Think a new carbon tax or stricter emissions standards. Second, there's physical risk. This is the most obvious one. We're talking direct impacts from floods, wildfires, storms, you name it. And third is technological risk. This is all about the disruption that comes from new green technologies that could make old ways of doing business obsolete.
But, and this is so important, it's not all just about managing risk. It's not just playing defense. For every single one of those risks, there's a flip side, a huge opportunity. I mean, the global shift to a low-carbon economy is probably going to be one of the biggest rewirings of capital the world has ever seen. And you can bet that these big investors are looking for ways to get in on the ground floor, to both finance that transition and, yeah, make a lot of money from it.
And that brings us right back to where we started, full circle. We kicked off with something as quirky as how a sunny day can affect markets. We've looked at how our beliefs can change the price of a house. And all of this leaves us with one final, really big question. And it's a question for you, the people who are going to be leading the world of finance next. So here it is. In the future of finance, how are we going to balance the value on a balance sheet with the values of our society? Look, this isn't some academic, philosophical debate anymore. This is the central, hands-on, practical challenge facing modern finance today. And frankly, your success in this field is going to depend on how well you can grasp and model this messy, fascinating intersection of risk, human behavior, and what value even means.